It's that time of the year again. Amanah Saham Bumiputra usually announces their dividends early in January, while EPF sometime around February. This year though, I think that both of these funds will give lower dividends compared to previous years. Let's find out why. Cha-ching! Amanah Saham and EPF are the country's largest fund managers. Millions of Malaysians subscribe to either one of them, or like in our case, we subscribe to both of them. As of last year, PNB has over 300 billion ringgit in assets under management, while EPF nears the 1 trillion ringgit mark. They're obviously handling a lot of Malaysians' money, and most of our retirements are actually kept there. If we've done our financial modeling and we're expecting a 6 to 7% return every year, then I have bad news for you. This year might not look the best. I'll give you 3 reasons that these funds might underperform this year and 1 potential reason that could see them outperforming. Let's get straight to it. The first point that could potentially derail their dividends is obviously the stock market crash. Indexes around the world were at one point down over 30% year to date. Ever since then though, things have recovered slowly and steadily. While some countries like China, India and South Korea have seen their stock markets already show positive returns year to date, our Southeast Asian counterparts like Indonesia, Singapore and Philippines are still down. The FBM KLCI, which is the Malaysian stock market index, is actually up just over 1% so far. Stock markets have actually performed very well in 2020, and if you only look at the year-to-date numbers, we wouldn't even have realized that there was a 30% crash just 8 months ago. The recovery has been insane. Now that I've said this, you must be thinking,
then what's the problem with the big funds? I mean, yes, stock markets crashed, but they've recovered already, so technically it shouldn't impact EPF and ASB, right?
well, I'll get a bit more into detail of that in my second point, which is something I like to call the big fund effect. The big fund effect is actually a scenario where a fund, if it gets too big, actually finds it harder to perform better than the market. Contrary to popular belief, as an individual investor, you can actually outperform some of these bigger funds. The reason for this is, the bigger these guys get, the more they find in terms of restrictions. It could be liquidity, or it could be simply managing expectations of the investors. What we've established is that the stock market has recovered since its crash in March. What we don't know though is if whether ASB and EPF actually participated in the stock market recovery. What we need to know is that there's a lot of scrutiny on both these funds to actually give good returns year over year. With millions of Malaysians relying on them to fund their retirements, one can only assume that they have a lot of pressure to give good returns every single year. Imagine managing a fund with 900 billion ringgit of Malaysian money and seeing this amount fluctuate by 5% every day at the height of it in March. That 5% fluctuation on 900 billion amounts to 45 billion ringgit of your assets fluctuating every single day. No matter how good you are as an investor, not many can stomach this. One of the things that might have happened is that both of these funds lowered their percentage of equities that they own in their entire portfolio. Equities are stocks, and generally they are higher risk. They drop more when the market is bad, and they rise more when the market is good. So when the market was bad in March, they may have raised some cash by selling some of their stocks. Bear in mind that back then, no one would have thought that the market will recover so quickly. So what happens when they have to sell off these assets just so that they don't lose too much money is that they miss out on the ride back up. That's a double whammy. You sell your stocks when it's close to the bottom and you lose money, and then you miss the ride all the way back up, so you've lost a potential gain. As an individual investor, it hurts seeing my portfolio drop by 5-10% every single day, but at least I know that it's just my money and I can hold on to it if I'm strong enough. I mean, it's my money after all. Even if it takes me years and years to recover to where it was before, I know that my retirement is decades in the future and I don't really have to worry. This is not the same for these funds who have to report the results every single year. I know that if this year my performance is not good, I'll be put under scrutiny and people will start questioning me as a fund manager. So, as an individual investor, when the stock market tanked, I didn't really have to do anything because I wasn't worried. If I was a fund manager though, I would have been slightly worried at least, and I might have sold off some of my shares, missing the ride all the way back up. Let's hope that that wasn't the case for EPF and PNB. I'm sure that they have many experienced fund managers who know what to do in this kind of scenarios. This isn't my biggest concern though. I'll leave that to point number 3, being the fact that investors are starting to pull out money from these funds. On the Amanah Saham side, there aren't any barriers for investors to withdraw their money from the fund. For EPF, I'm sure that most of you already know that we can start withdrawing some of our EPF savings for our day-to-day expenses. We even covered this in our Budget 2021 video, which we posted 2 weeks ago. Now, the problem with people starting to withdraw their money from these funds is two things. First of all, these funds will have less money to invest in the stock market. That's not too bad. The second one is even worse. These funds may actually have to sell off some of their assets just to pay back these investors who want their money now. This is how it works. I'd assume that these funds operate in a way similar to a bank where they have a set percentage of their assets that they have to hold in cash. The reason they do this is that they can't invest every single ringgit that we put into ASB. They have to keep a certain amount so that whenever people want to withdraw, the cash is always available and they don't have to sell off their assets. Let's say that previously this was set at 5%, where the remaining 95% of cash in this fund is free for them to invest in whatever they like. Now though, with a lot of people looking to withdraw more and more money from these funds, let's say they have to increase their threshold from 5% to 20%. Suddenly, only 80% of the cash in their fund is available for them to go out and invest. Now, this is a huge difference. Basically, the more money EPF and PNB have to set aside for potential withdrawals, the more difficult it is for them to distribute high returns to all their investors in the year. They may have to liquidate some of their assets that may have a good short-term outlook. Remember how the stock market has recovered tremendously since its crash in March? Well, imagine if you owned shares of Apple in March, knowing it's undervalued and it'll go up eventually, just to be forced to sell it because someone wants their money back. This makes the funds miss out on potentially 100% worth of gains that they could have had if people didn't want to withdraw their money. The EPF chief has already warned of lower investment returns this year and the potential need for them to rejig their portfolio because of all the policies that are coming in. Just as I was doing this video, I also found an article talking about how lower EPF returns this year are imminent. I guess someone thinks like me at least. Another semi-related thing is that if these funds will have to liquidate some of their assets to give it out as cash to investors, then it might impact the stocks in the FBM KLCI. Since these two guys are the biggest players in the Malaysian market, any sale by these guys has the potential to really move the needle. So if you're investing in any of the Malaysian stocks, just keep an eye on this. I don't think it'll be a big deal because these guys are experienced and they know how to sell stocks without influencing the market too much. One potential bright spot for these guys though is the fact that volatility has been incredibly high in 2020. The thing about trading is that the more volatile it is, the easier it is for you to make money. We can already see this in the banks of the world. US banks like Goldman Sachs, JP Morgan, and Citibank has all seen lower net profits in total because of defaults, less people taking out loans, and just generally a worse economy. However, one bright spot for all of these banks is that their trading profits have shot up tremendously in 2020. This is because these guys feed on volatility. When the stock market goes up and down by a lot in a single day, there's a bigger range for them to play to make some quick profit. I'm not sure if the fund managers in ASB and EPF take on these short-term swing trades just to make a profit, but if they do, then there's potentially better returns for all of us. I'm pretty sure I've looked at a tracking website on the FBM KLCI where we saw EPF and ASB both buying up shares of beaten up stocks back in the days in March. Buying right at the bottom and selling it off quickly for a quick gain could really help out the returns for this year. So, having given the 3 reasons that they may underperform and 1 reason that they may outperform, what do you guys think? Let us know down in the comments down below whether you think that both these funds will return a higher or lower return this year. My bet is they'll still give lower returns because they want to manage expectations moving into 2021. But let's see. Having said all of this, I just wanted to touch on the last point regarding ASB financing. Is it still worth it with lower returns and an uncertain economy? We need to remember that interest rates have also dropped a lot this year. I used to pay around 530 ringgit every single month for my ASB loan, but now it's reduced by almost 15% to just 460 ringgit. That's 70 ringgit less than I'm paying every single month. A lower return from ASB could potentially be offset by lower interest rates in general. This means that our investments could return just as much as they did in 2019. I'm sure that PNB is also eyeing this out, as they don't want people who invest in Amanah Saham through the financing method to lose money. I'm not affiliated with them in any way though, so just remember that whatever you do with investing, there's risk to it, and make sure you know the risk and are comfortable with it. If you want to watch a video that YouTube thinks you'll like, click here. If you want to watch a video on Budget 2021 and how it'll impact you, then click right here. See you in the next one. Peace out.